Before major market crashes, something strange often happens. Investors become more confident, prices become harder to justify, and almost everyone believing the good times will continue. The first warning isn't panic. It's the opposite. It's when investors stop being afraid. Then comes FOMO. People who never cared about investing suddenly want in, not because they understand the risks, but because they see everyone else making money. Then something changes. The market stops asking, "What is this company worth today?" and starts asking, "How much higher can the price go?" When prices rise far faster than the profits supporting them, the market becomes more sensitive to bad news. A small disappointment can suddenly matter much more than it did before. Financial conditions matter too. When borrowing is cheap and liquidity is abundant, investors can take more risk. But when conditions tightened, the same leverage that helped prices rise can work in reverse. Leverage makes this even more dangerous. Borrowed money can magnify gains on the way up. But when prices fall, it can force investors to sell at exactly the wrong moment. And we've seen versions of this pattern throughout financial history. Confidence rises, risk gets underestimated, prices become increasingly dependent on optimistic expectations, and eventually, something changes. But confidence alone doesn't create a crash. Usually, the market needs a trigger. A surprise in inflation, interest rates, or something investors simply didn't expect. At first, almost nobody panics. A few investors sell, prices dip. Most people call it a normal correction. Then psychology takes over. Falling prices create fear. Fear creates more selling creates lower prices. And suddenly, the market isn't reacting to fundamentals anymore. It's reacting to itself.
One of the scariest moments comes when liquidity starts disappearing. When there aren't enough willing buyers, even a relatively small wave of selling can move prices much further than people expect. And this is when a correction can become something much larger. Investors once feared missing out, now fear losing everything. Greed flips into fear.
But here's the part most crash videos get wrong. There is no magic warning sign that appears before every crash. Markets are complicated, and every crisis has its own trigger.
So what happens before a market crash? Usually, because when expectations change, everything can change with them.
Instead of searching for one perfect signal, watch the combination: stretched valuations, excessive leverage, weakening, and finally, a catalyst capable of changing expectations.